Hello everyone, and thanks for watching Edupedia World Videos. In this session we'll discuss about preparation of cash flow statement. Now you must be aware that cash flow statement contains three parts. First we have to calculate the cash flow from operating activity, then cash flow from investing activity, and finally the cash flow from financing activity. Now students must be aware that which of the activity would be falling in operating activity, which would be in investing, and which would be in financing. So before we go for the question, I would suggest the students should first clear off the theory part from any book, and then they can learn how to prepare the cash flow statement using this example. So let us start with this example, and I'll explain things which would be complicated to understand meanwhile. So starting with the first section that we have here is cash flow from operating activities. You can name this section as part A. So the very first element that we have to incorporate in cash flow from operating activity is net profit, and that too before taxation. And any other extraordinary item. Now the question is how to compute this. We have profit and loss account for 2004 and 2005. So we have to understand the working, how the working will go on. So to explain the working, I'll open a next sheet. Okay, so for net profit during the year, what we can do is deduct the last year's profit from present year profit to get this value. So in present we had 3,50,000, and we deduct 2 lakh from it, so we get 1,50,000. So net profit during the year. Now what we have to do here is like we are provided with few informations. So there is a provision for taxation. So we have to understand that whenever we make a provision, we set aside some amount for future need of that particular item. That means for 2004, 30,000 has been kept aside for the payment of tax, but it has to be and it will be paid in 2005. Now, same happens in 2005. The taxation provision was 50,000. That means that 50,000 was kept aside but has not been paid, so there is no cash flow. So we have to add back this amount to the net profit, because actually this has not flown out of the business. So we'll add provision for taxation during the year. So it was 50,000. Okay, sorry. So we'll add these two, or you can just, and this is our net profit before tax and extraordinary item. So we'll take this amount as our first entry. Here, I'll write in rupees. Okay, now we move to the next items, like we have to add back all those elements which are non-cash items. So provisions for all those items would be included. So first one is depreciation. Which is 15,000 and 30,000. Okay, so depreciation for equipment. Depreciation for equipment was 15,000. Okay, mistake in the spelling. Let me rectify that. Okay, next we have depreciation for furniture. The amount is 30,000. Now we have to look for other non-cash items. Okay, we'll just go through the balance sheet and we'll find out any of those. Okay, so in patents we have seen a decrease of 5,000. Patent is a kind of asset which is intangible, so any decrease in the value of intangible asset is called to be amortization. So we use the term written off for them. Written off. So write-off is the word used for if there is a decrease in value of patent or goodwill. So you can write patents written off or goodwill written off, or you can also write like patents amortized or goodwill amortized. They both work. So we'll write the amount. So the amount would be the difference in these two. So just take the difference. Next we check for another element, another non-cash item, or something like some item which hasn't created any cash flow during the year. So one we have incorporated in net profit before taxation provision, another one is left out, and this is proposed dividend. So whenever dividend is proposed, it is not paid in that particular year. The proposed dividend is paid in the next year or in the consecutive year, you can say. So the provision is made in that particular year, but there is no cash flow in that year. So we have to add back the proposed dividend. And one more thing you can means you should know is like if we propose for 2004 50,000, the amount would be paid in 2005. So in 2005 50,000 would be the dividend paid, and this would be incorporated in the cash flow. And if we have to prepare the cash flow for 2006, then this 70,000 would come in 2006, not in 2005. Okay, hope you understood. So we just write the proposed dividend, that was this amount. Okay, now there is another element which we have here is, let me check. Okay, so we have loss on sale of equipment. So we'll incorporate this. The reason for this to be incorporated here is this is not your operation. Any loss on sale of equipment or any profit on sale of equipment would be deducted, added and deducted respectively, because it is not the part of operating activity. So whenever you lose on sale of equipment, that needs to be added back to the net profit in order to calculate the cash flow from operation, because this is not your operation. Operation is something which the firm intended to do, which the firm has the objective, like an FMCG company tried to sell soap, washing powders, and other elements like that, creams, mm, and deodorants, maybe oil. So this is the part of operation, not sale of equipment, because equipment has to be and is meant to be used by the business for production, not for sale. So we'll incorporate this. Loss on sale of equipment is 5,000. Now we have to check for operating. Okay, working capital changes would be incorporated here. So before that, I'll write operating profit before working capital change. Okay, so let me just total the amount. Okay, now we'll write all the working capital changes. So we'll look for the working capital elements. First we have here is creditors. Okay, so there is decrease in creditors, decrease in creditors. So whenever there is decrease in creditors, that means some payment has been done during the year. That means there is decrease in cash. So we'll deduct this amount from the cash. Okay. Next we have is outstanding rent, and there has been increase in outstanding rent. Increase in outstanding rent. So increase in current liability means the payment has not been done and there has been no flow of cash. It means any increase in current liability is addition to the cash flow. Next we move to the current assets. In current assets section we have debtors, and debtors has increased. So increase in debtors. The amount is 40,000. So increase in debtors is something a company doesn't want, because increase in debtors means the cash has been stuck with somebody, so the company doesn't want it, because there has been no inflow of cash. That means it is negative for the company. and negative for the cash flow. So we'll put a negative sign for this because it has to be deducted from the cash flow. Increase in goods, what we have here in stores. So we'll write this one. And we'll have a negative sign for this also, because any increase in current asset means the cash has been stuck with that particular element. So increase in goods. Now we'll calculate all these incorporating all these elements and use this. Sorry. Okay, this is the cash generated from operating activity. Cash generated from operating activities, and we have to deduct tax from this. So tax paid. Okay, the tax paid would be the one that is the provision for the last year. So the provision made last year would be paid this year. So we'll deduct 30,000 from this. And this is our cash flow from operating activity. Cash flow from we'll name this section A, as we have named it. Now we'll calculate the cash flow from financing, or we'll start with cash flow from investing activity. Let me change it. This is section 1. Now we come to section 2. Cash flow from investing activities. Okay, so any sale or purchase of asset would be incorporated in cash flow from investing activity. So first we have here is proceeding. First we have here is we have equipment. There has been a purchase of equipment because equipment has increased. Purchase of investment. So first of all, we'll incorporate the investment because it would be very easy to incorporate this. We are pretty much certain that there has been purchase of investment. The amount is 1 lakh. Okay. For purchase of new equipments, we have to find out, like, it has been given like equipment costing 80,000 was purchased, so we can write purchase of equipment, which is 80,000. Okay, we have to put a negative sign here before them, like any purchase would be causing decrease in cash flow, because any purchase is meant is understood as outflow of cash. So any outflow is negative and inflow is positive. So next we have, like, during the year there has been a sale of equipment, so we have to calculate the proceeds from sale of equipment. Now let us see how to do this for this particular question. So proceeds. Okay, what we'll do first is in the last year there was 2 lakhs was the value of the equipment, and during the year there has been a purchase of equipment worth 80,000, so the amount comes to be 2,80,000. Now the depreciation for the year was 15,000. So we'll deduct 15,000 from this. Okay, 2,80,000. We'll deduct 15,000 because this has been depreciation. Or we can write this more systematically. This was last year equipment. Value. This is purchase during the year. Then this is the total amount. Now this is the depreciation, and there has been loss also, loss on sale, that is 5,000. So the amount comes to 2,60,000. The balance for this year, balance for 2005 is 2,30,000. That means that there has been ₹30,000 has been gained from proceed of sale of equipment. Hope you understand the process. Like we have added the total, like what we had and what we purchased, then we deducted all the depreciation and losses, so that the rest amount we can find out, and the balance we had for 2005 is deducted, so we can estimate the proceed from sale. So we'll write here proceed from sale of equipment. You can also try to find this proceed from sale of equipment by making a ledger for equipment. So this is 30,000 as we have calculated. Cash flow from investment, or cash flow from investing activities would be summation of these three. So this is 1,50,000 on the negative side. And lastly, we have cash flow from financing activity. Okay. So in financing activity, there would be incorporation of any issue of debenture, loan, and equity share capital, payment of dividend, all would be incorporated here. So we'll first see there has been increase in equity share, so we'll write that. Issues of equity shares, so the difference amount for the 2-year would be written here. Then what we have is next we come to the bank loan. There has been decrease in bank loan, that means the payment has been done. So payment or repayment of bank loan, this would be having a negative sign because this is an outflow. Then we have the proposed dividend for the last year, which would be paid this year, so payment of dividend. Last year's proposed dividend would be written here, so this would be 50,000. Now let us check if there is anything left out. Okay, we are finished here. Okay, so we'll sum all these. So this is your cash flow from financing activities. You call this section C, and this is your B. Okay, So what we'll do to find out the total cash flow or net cash flow is to add all these three. So this one, and this one. This is your net increase because this is positive. The sign is positive, that's why this is I have written net increase in cash flow or net increase in cash and cash equivalent. Okay, now a very good method to find out whether you have successfully and correctly found the net increase in the cash flow, cash or not, whether your cash flow is correct or not. You just add the last year's cash and cash equivalent, cash and its equivalent for last year. So just write that. Okay, in cash we have 5,000, in bank we have 2 lakhs, so we'll write 2 lakh 5,000 and we'll add both of them. So the amount which we have got here, this should match with the next year or for the present year, like 2005's total cash and cash equivalent. And we can see that if we add cash and bank for 2005, it's 3,27,000, and what we have got here is 2,70,000. That means our cash flow statement has been correctly prepared. Hope this video helps you understand the preparation of cash flow statement.